Hi everyone, my topic for today's video is foreign direct investment. In short, it is also called as FDI. The question is, what is FDI and why does it matter? When foreign investors invest in the companies in our country, it is considered as foreign direct investment or FDI. It means that foreign investors acquire ownership in the business activity. Foreign direct investment occurs when an investor based in one country acquires an asset in another country with the intention to manage it. The intention is important here. The intention is to manage the company, not the short term gain. Foreign portfolio investment, in contrast to FDI, that is direct investment, we have foreign portfolio investment. What is foreign portfolio investment or FPI? When foreign individuals, firms, or public body invest in financial instruments of our country, such as stocks, government bonds, etc., we call it foreign portfolio investment. In FPI, the equity stake in foreign business entity is not significant enough to exert any management control. So here the FPI or the foreign portfolio investors are not interested in exercising any management control. In fact, they are not interested in any long term investment. They are looking for short term gain, and when they are getting that gain, they'll take the benefit and go. And that is the reason foreign portfolio investors are also called as fair weather friends, because when weather is good, they'll come all in one go, and when their investment is at risk, when they find slightest changes in the environment or when they expect any risky thing going on, they will immediately all push off. And because of this, the volatility in the domestic market also increases. But foreign direct investors, they are looking for long term investment. They want to exert management control, and therefore they help in the economic development of the country, and that is why FDI is considered as the most important one, and most of the developing countries or underdeveloped countries are taking steps to encourage FDI in their economies. Now, what are the benefits of FDI to the host countries? FDI brings superior technology with them. They increase the competition, and with increased competition, efficiency also increases domestic investment. They bridge host countries' foreign exchange gaps. This is again the most important. Most of the underdeveloped countries or developing nations, they have the gap in their balance of payments. They have deficit. Their exports are less, imports are more. So their inflows are less, outflows are more. And this deficit, if they have foreign direct investment or more investors coming in, then that deficit can be bridged up. There are certain negative impacts of FDI also, like it may lead to market monopoly, it may have crowding out and unemployment effects. Domestic investment may leave the industry because of competition, and that will lead to unemployment. Technology dependence, we become dependent on the foreign technology. FDI, of course, it brings in foreign exchange uh, when they come in, but every year there will be profit outflow. Sometimes they lead to corruption also, because they want to get their work done and they give bribes to government officers and politicians, and sometimes to avoid regulation, and then sometimes the national security is also at stake. Now, the question is, what are the factors on which FDI destinations depend? How do companies select where to invest, which country to invest? There are various factors. The first is cost of capital input. If capital is cheaper, it is easier to get loans at low rate of interest. They'll prefer that than wage rate. Nowadays, most of the companies are preferring India and China because of cheap labor, so that the cost of production can come down and they can become more competitive in the international markets. Taxation regime, if taxation regime is favorable or the regulations are less than the FDI, then for FDI it is a preferred destination. We had GST reforms also keeping this in mind. Cost of inputs, then cost of logistics and market demand. Market demand is also one of the important factor. India and China again are the preferred destinations because they have the big market demand. The next thing which we are going to cover is the types of FDI. FDI, on the basis of direction of investment, is categorized into two categories: inward FDI and outward FDI. When FDI comes into our country, it is inward FDI. If FDI goes out of our country, it is outward FDI. Most of the countries want inward FDI, but they want to control outward FDI. Like in India, also we have number of controls on the outward FDI. But when you are permitting inward FDI, you are encouraging inward FDI. You have to permit outward FDI also. It cannot be in one direction. Then, on the basis of type of activity, we have horizontal FDI, vertical FDI, and conglomerate FDI. FDI is horizontal FDI. If investment is in the same line of activity as carried out in the home country, that is, the company produces similar products or same products in the foreign countries as well. Vertical FDI. Vertical FDI is when the company wants to get inputs for its domestic output, or it wants market for its domestic output. It is backward vertical FDI when the aim of FDI is to provide inputs for the firm's production process, and forward vertical FDI when the aim is to provide market for its domestic production process, and conglomerate FDI when it is maybe the combination of horizontal or vertical, or maybe in the diverse line of production. On the basis of investment objectives, we have resource seeking FDI. If FDI is if the aim of the FDI is to gain access to certain resources vis-a-vis the competitor. Market seeking FDI, if the aim is to gain a sizable part of the market and preclude the rivals or the competitors from entering the market. Efficiency seeking FDI, if aim is to reduce the cost of production or to gain the advantages of specialization due to economies of scale, the firm may want to expand and gain the advantages. On the basis of entry mode, we have greenfield investments and mergers and acquisitions. It is considered as greenfield investment when the company starts up the new facilities in foreign countries from the scratch. That is, it doesn't buy the existing company, it sets up its own company, it sets up its own business in the foreign country. If it buys the existing company, it comes in mergers and acquisitions, M&A, maybe it will merge with the existing company or it will acquire the existing company. If the company wants to go for greenfield investments, company needs to do good market research, environmental research is required. If it is acquiring the existing company, this is not required. But when the company wants its organizational structure or its business structure to be preserved, it goes for the greenfield investments, because if it acquires the new company, then the organizational traditions, customs, or the structure, whatever has been existing in the earlier company, will be coming to the new company as well. And it is difficult to change all this. So, greenfield investment is preferred in this case. On the basis of sector, we have industrial FDI and non-industrial FDI. If FDI is in the manufacturing sector, then it is industrial FDI. And if it is in the service sector, it is non-industrial FDI. On the basis of strategic modes, we have export replacement. If FDI is made as a substitute for exports in response to trade barriers of the host country, like import restrictions and prohibitive trade structures. So, already the company may be exporting its goods to this country. And now, since the country has started with the restrictions on imports, the company, rather than exporting its goods to the country in concern, it will set up its own company there. So, no need to pay the tariffs and go through the prohibitive tariff structure. Export platform, sometimes maybe the company in America wants to export its goods to all the countries in Asia. Then the Asia, it's too far and it will have to incur transport cost. So it may set up its branch or subsidiary in India, from where it will export all the goods to all the Asian countries. So it will be cheaper for it. So India becomes the export platform for its exports to the Asian countries. And the last one is domestic substitution, when FDI is aimed to obtain cheap inputs to support home production. Uh, Thanks for watching.